What if I told you there's a tax trap quietly costing retirees hundreds of thousands of dollars, and most people don't even see it coming? I'm Hunter Brockway, founder of Boker Retirement Strategies. Today we're going to expose the single worst tax mistake I see professionals make before retirement and how you can avoid paying an extra $250,000 over your lifetime. At Boker Retirement Strategies, we help busy professionals take the mystery out of retirement tax rules so you can keep more of what you've built. In the next few minutes, I'll walk you through exactly what the trap is and why it hits so many people and the 3-step roadmap to protect yourself. Let's dive right in. The trap I'm talking about is when you assume you'll fall into a lower tax bracket in retirement, and you don't. Here's how it plays out. You're nearing retirement, you'll think you'll be drawing down your savings at, say, a 10% tax bracket. You've planned your lifestyle around that. What many don't consider is the stacking of different income sources like a pension, Social Security, IRA distributions, maybe a rental or a side business. These add up and push you into a much higher tax bracket without you realizing it. For example, one of our clients, let's call her Sue, thought she'd be in the 12% bracket after retirement. Because she had a pension plus her IRA plus a small rental property, she ended up in the 22% bracket. That difference alone cost her more than $250,000 across her retirement. Don't assume your tax bracket drops just because you stop working. Now, why does this happen so often? When you retire, your income mix changes. Social Security, pension, RMDs, taxable rentals, they all stack. And if you plan on a 10% bracket but forgot about a surcharge like the IRMAA premium for Medicare, or forgot that your state taxes still kick in, that number creeps up. Let's call our annual enemy Mean Aunt Irma. She shows up uninvited and raises your Medicare premiums. It's real. For example, a married couple filing jointly, just a few $1,000s of extra modified adjusted gross income can trigger that IRMAA surcharge, costing thousands more annually. So second takeaway, map out all of your income sources and how they interact. Don't just focus on the nest egg number.
This video got you thinking about your own retirement planning. I'd like to offer you something to help you see the bigger picture. We've created a tax-smart, comprehensive retirement workbook for pre-retirees and retirees. If there's one thing I've noticed in my years of working with individuals, it's that there's always at least one aspect in the planning process where they say, I haven't thought about that before. No matter how smart they are, how much they've saved, something comes up, whether it be they realize they can spend more than they thought they could. They realize their tax bill is going to be higher in retirement. They are going to leave money on the table with their current Social Security claiming strategy. This workbook is designed to help you walk through the most critical areas of retirement planning with action steps, false beliefs, and areas for you to input your own reflection items. You can download the workbook by going to the link below in the description. If you have any issues with that link, send us an email at contact@bokerretirement.com. If you get through this workbook and you'd like your responses reviewed or have any questions, I'm happy to have that conversation with you too. As always, this is no cost, no obligation, and no pressure. Best of luck.
Here's your 3-step roadmap to avoid the trap. Step number 1, project your income in retirement by year. Include pensions, Social Security, RMDs, rentals, side gigs. Step number 2, run alternative tax scenarios. Ask, what if I do a small Roth conversion before retirement so I can reduce future withdrawals? Step number 3, align your withdrawals to minimize bracket jumps and IRMAA triggers. Pull from the right account at the right time. Consider qualified charitable distributions if charitably inclined, and review annually because life changes. Think of your plan like a garden. You don't plant it once and walk away. You check back each season, pull weeds, and harvest smartly. If you do these 3, you're much less likely to overpay and more likely to keep your retirement vision intact. If this resonated with you, I've got something for you. We've created a tax-smart retirement workbook that walks you through building a smart money plan with your own numbers and info. Grab it from the link in the description below and you'll get immediate access. So let's recap. Number 1, don't assume your tax bracket drops just because you stop working. Number 2, map out all of your income sources, pensions, Social Security, RMDs, rentals, side gigs, and how they all interact. Number 3, use the 3-step roadmap, project income, run tax scenarios, and align withdrawals. By doing this now, you're keeping more of your money and staying in control of your retirement years. Thank you for watching. I'm Hunter Brockway with Boker Retirement Strategies. Enjoy your successful retirement with more money, less stress, and fewer taxes.